I'm Sebastian St. James. In a previous video, one of my viewers asked, "Thanks Sebastian, it's a great video again. What's your outlook on index funds like VAS, especially in a down market like this and dividend yields go up? So should you buy VAS? VAS is Australian index fund, and there are two reasons why you might like to buy into an Australian index fund. Number one, the dividends are so much higher than virtually anywhere else in the world. And secondly, there is a secret that most people don't even know, that if you hold a dividend fund in Australia, more than $5,000 in an Australian ETF, you get a free kangaroo. That's right. In Australia, we tend to keep our kangaroos in the backyard along with the chooks. We ride our kangaroos to school. I mean, who wouldn't? Obviously, make sure you get one that's the right size. Don't make the same mistake as Rebel Wilson. Besides getting your kangaroo, Australia pays much higher dividends than virtually anywhere else in the world. Here are the dividends of VAS, the index fund we're talking about. It has 4.7% as of the 30th of June. That's the dividend yield. If we compare that to the US, the S&P 500 and the IVV index fund, which is available here in Australia, you will notice you get, 1.49%. That's pathetic. The ASX 300 gives you 4.7%. The S&P 500 gives you 1.49%. That is dividends. But dividends are no good alone if your share price goes down and you lose all your money, right? So let's compare the share price between Australian funds and US ones. Here is the 1-year return on the VAS, ASX 300 in the red and green. In the black, you have the S&P 500, and you'll notice the S&P 500 has outperformed the VAS. Oh, there you go. Over the 1 year, minus 10% for Australia and minus 2%-ish for the US. So the US wins there. We're not into short-termism. Give me a longer time frame. This is the same comparison over 2 years. You notice, well, partly the VAS has done fairly well. As the time goes on, you notice the American market outperforms the Australian market again. Around about 26% for the US market, perhaps 13% for the Australian market. Yeah, US wins again. Over the 5 years, let's get to some real time frames here. Well, the Australian market is a no-show. The US market has done very well over 5 years. Let's get real here. If you're investing, you're probably investing for decades. Let's look at 10 years. Over 10 years, the black line, of course, is the US, and, well, it just keeps going up and up. And by comparison, the Australian line, well, just meanders along the bottom. It is going up. It's gone up 57% over that time, but the US markets, the S&P 500 has gone up about 340%. There is no comparison. The US market is winning time period after time period after time period. One thing to keep in mind, though, that these graphs do not include dividends. Why? Well, dividends are actually paid out. They are not retained within the fund, and therefore the share price does not reflect retained dividends because there aren't any. So if you include dividends as well, which Australia, remember, it's much higher for, so no wonder the graph is lower if it's paying out a high rate of dividends, right? How does our rate of return compare? We're going to compare now the total return, which is the NAV, which I'll explain to you in a minute, plus the distributions or the dividends, if you like to think of it that way. NAV equals net asset value. When we're talking about ETFs, index funds, they're actually holding the real stocks, the underlying assets, so they have those in billions of dollars. So when we're talking about the ASX 300, we're talking about the 300 stocks, which the index fund is holding. The S&P 500 is holding the 500 stocks. So now we know what the net asset value is, the NAV, right? It's simply the sum of all the stocks that they hold added up. So we know that's an exact value. Does the stock price equal exactly the NAV, the underlying value of the assets? The answer is no. Firstly, the NAV of the index fund is not quoted live. Well, it probably is to institutional investors, but to you and I, retail investors, no. So how do you know the true value of the index funds which you're about to buy into? Well, you don't. You're out of date. Secondly, although the ETF has a real dollar value, an exact amount that that fund is worth, in reality, when people come to buy into an ETF, if you put into your stockbroker VAS, enter and have a look at the fund and then press the buy button, at the moment its price is $50.50. You offer $49.50. Finally agree on, say, $50.15. You've met somewhere in the middle. Is that based on NAV, the true underlying net asset value? No, it's based on how much you personally were willing to pay and how much the seller was willing to drop their price by. That is a huge problem, because an index fund is supposed to be based on the index, the underlying assets which it holds. And now you're telling me that's not the price at all, that the price of the ETF actually fluctuates according to buy and seller demand in the market at the time. The market maker is a company that the index actually employs to be in the market. It does two jobs. In particular, it provides liquidity. So if you want to buy or sell an ETF fund at any time, you can. So let's say that the true value, the NAV at the moment is $50. So they will offer to buy shares at, say, $48 and offer to sell shares to you at $52. And the 50 is in the middle. The true value is in the middle. And therefore, they are making money on that spread. But in this way, by capping how much you pay for a share and how much you sell for a share, more or less over a period of time, the market maker ensures that the ETF's price equals roughly the underlying NAV. I showed you the graphs and how well the US versus Australia performed. Now let's look at total returns, which does include dividends. Over the 1 year period, the ASX 300 returned minus 2.24%. The S&P 500 returned minus 4.6%. So over the 1 year, Australia wins. Over the 3 year period, we find the ASX returned 4.48%, the S&P 500, 13.33%. Over this period, the US wins. Over the 5 years, Australia returned 8%, America returned 12%. Oh, okay, the US wins there. And over 10 years, Australia returned 9%, the US returned nearly 14%. The US wins. Including dividends, over the 1 year, Australia won, but all the other time periods, no, the US won. So, does this mean that I should ignore Australia and then buy into the US? Well, past returns do not indicate future returns necessarily. But statistically, yeah, you would be better off buying into the US market. Is the Australian market more or less volatile, in other words, how much the share price will go up and down by, than the US market? Well, here's a table for you. Over the last 3 years, the ASX 300 has the standard deviation, how much it's gone up and down by, 18.87%. The S&P 500 is 19.24%. So yes, in this time period, the Australian market is slightly more stable than the US market. If that's important for you, there's the data. So if the US market actually outperforms the Australian market, why? Is it just because Americans think they're better? Well, they do. But let's have a look at the underlying data. Here are the top 10 holdings of the ASX. It starts with BHP, which is 10%, and it is a mining stock. Commonwealth Bank, which is in financials, and that's 7.73%. CSL, biotech, that do blood products, is 6.4%. In the US market, we have Apple as number one, which is in IT, and it is 6.57%. Microsoft is next at 6%. Amazon is next. Notice there's two Googles. This is important. Really, there's only one Google. There's only one Alphabet, but they have two classes of shares, so we'll list them as two separate shares, although in reality, it is one company. I have summarized that for you, and this is where the real insights come. In the finance sector, Australia has 5 stocks, the US has 1. So straight away you can see Australia is big on finance. In resources, Australia has 2, the US has none. Australia has 1 in health, the US has 2. In retail, Australia has 1, the US has 2. In communications, the Australia has 1, the US has 2. And in IT, Australia has none. This is very significant. The US has 3. The market segments that Australia is big in and the US is big in is totally different, and that accounts for a large amount of the discrepancy between where Australia performs versus the US. Also, our concentration matters as well. The number one stock in Australia is 10.47% of the index. In the US, it's down to 6.57%, so almost half. Our second stock is 7.73%. The US is 6%. Go down to number 5, 3% for us and only 1.89% in the US. So Australia is a lot more concentrated. That means a lot more of our market is up in the big companies versus the US. Is this though that the S&P 500 has 500 stocks, whereas the ASX 300 has only had 300 stocks? So of course, if you divide the market up into 300 pieces versus 500 pieces, naturally the ASX market is going to be more concentrated. Is that all I'm seeing here? Well, no. The ASX 300, right, only 300 stocks, represents 85% of the market. The S&P 500, 500 stocks, represents 75% of the market, so it's the opposite to what you'd think. Although we're dealing with fewer stocks in Australia, we're actually representing a greater amount of the market than the S&P 500 is. That leaves one important question. Let's say that you've heard the data I've presented to you, but you've decided that you definitely want to invest in an Australian ETF of the Australian ASX market because you get the higher dividends plus you get your free kangaroo. Is the VAS the right index fund to cover the Australian market? Or should I go with STW or A200 or some other index fund? That is a question I'll answer in part 2 in a future video coming up shortly, so make sure you're subscribed so you don't miss out. What I can answer for you right now is what are the best dividend stocks in 2022. Click here and find out.